Good evening. Extremely warm welcome to City, University of London and to the Sir John Cass Business School. Before we begin, I'll take a few moments to bring you up to date with our progress at City and also at Cass. As many of you will know, City was established in 1894 and we obtained university title in 1966, and we've come a long way since then. We have very strong connections with the City of London. The City's worshipful companies have supported us since Victorian times, and the Lord Mayor of London is our rector. We attract around 19,500 students, over a third at postgraduate level, and we are the only university in London to be both committed to academic excellence and focused on business and the professions. And this powerful combination ensures that our courses are popular, our students remain employable, which is very helpful in these times, and our international reputation remains strong. In the past few years, we've invested heavily in our academic staff, in our infrastructure and in our estate. Now, I'm delighted to say that these are bearing fruit, because we've more than doubled the proportion of our academic staff producing research of internationally excellent or world-leading quality, and we've increased the satisfaction of our students by more than any other university in the country. So currently we have the most satisfied undergraduate students in London. As some of you will know, last September was another important milestone for us because we joined the University of London. And we now are part of a bigger group, which includes UCL, King's, the LSE, Queen Mary, Royal Holloway, LBS, SOAS and Goldsmiths. If I say a few words about Cass, I know there are many Cass alumni in the audience. Cass currently ranks in the top 4 in the UK, the top 20 in Europe and the top 50 globally. The school emphasises 3 interwoven elements of knowledge, education and community. Regarding knowledge, the latest Research Excellence Framework assessed that 84% of the research we submitted in finance, actuarial science and management was world-leading or internationally excellent, and ranked the school second in Europe for research impact on business and policy. Regarding education, we teach around 4,000 students each year on undergraduate, master's and continuing education programmes. And as far as community goes, our alumni network now stretches to 37,000 professionals across 160 countries. Turning to tonight. The annual Mais Lecture is the City of London's foremost event for the banking and finance community and is attended by senior practitioners and, of course, academics. Since its inception in 1978, it's maintained a tradition of prestigious speakers, including names such as Tony Blair, Gordon Brown, Mark Carney, Mervyn King and George Osborne. This year, I'm pleased to say, is no exception, and I'm delighted to welcome Lord Griffiths, to give this evening's lecture. Lord Griffiths established the Centre for Banking and International Finance at City in 1977, before becoming Dean of the Business School in 1982. He was a non-executive director of the Bank of England from 1982 to 85, and then served as head of the number 10 policy unit until 1990. He has been an international advisor to and director of Goldman Sachs International and a member of several company boards and the House of Lords Select Committee on Economic Affairs. He has chaired the Archbishop of Canterbury's Lambeth Trust and is at present chairman of the Centre for Enterprise Markets and Ethics at Oxford. I'll now hand over to Professor Paolo Volpi to say a little more about the lecture. Paolo, thank you.
So thank you very much, Sir Paul. So, ladies and gentlemen, my name is Paolo Volpi, and I'm the head of the finance faculty here at Cass Business School. I'm delighted to welcome you on behalf also of Marianne Lewis, the Dean, to the Mais Lecture this year, one of the foremost events for the business and finance community in the City of London. I'm especially delighted today to introduce Lord Griffiths, who will deliver the Mais Lecture. We are honored that he was able to join us to share his thoughts and experience. Now, before we begin, as we say to our students, repetitions are useful. I will repeat some of the things so Paul already mentioned. So the Mais Lecture itself was established in 1978 to honor Lord Mais, a former Lord Mayor of the City of London and Chancellor of the University. Lord Mais played a key role in establishing the Centre for Excellence for Banking and Finance, and the centre is now at the core of the Faculty of Finance, one of the largest and most widely recognized in the world. We have a total of 50 full-time members and 20 visiting faculty, and we have 1,200 undergraduate students and more than 900 postgraduate students studying finance here. Now, our academic research is thriving, and in the latest ranking of economic research done by Ideas, we are 4th in Europe and 32nd in the world in finance. Now, the lecture, since its inception in 1978, has welcomed a long list of acclaimed speakers. As Sir Paul mentioned, governors of the Bank of England, Chancellor of the Exchequer, future prime ministers, a Nobel Prize winner, and heads of the International Monetary Fund, the Federal Reserve, and the Bundesbank. And Lord Griffiths is no exception to this prestigious roll call. As Sir Paul said, Lord Griffiths has a long and distinguished career. He graduated from London School of Economics. Everybody makes mistakes, and taught there from 1965 to 1976, but then he came over to City University and established the Centre for Banking and International Finance in 1977, before becoming Dean of our business school in 1982. He left in 1986 to serve as the head of the Downing Street Policy Unit under Margaret Thatcher, but has remained a very good friend to the school. In his role at Downing Street, he was responsible for domestic policy making and was one of the chief architects of the government's privatization and the regulation programs, as well as in charge of the education and broadcasting policies during Mrs. Thatcher's term in office. On leaving number 10, he was made a life peer. Since then, Lord Griffiths has been vice chairman of Goldman Sachs International and international advisor to Goldman Sachs, concerned with strategic issues in the UK, European, and Asian operations, and business development activities worldwide. From 1991 to 1993, he was chairman of the School Examination and Assessment Council, and from 1991 to 2000, chairman of the Centre for Policy Studies. As Sir Paul mentioned, he is also the chairman of the Archbishop of Canterbury's Lambeth Trust, and he's, of course, written extensively and lectured on ethics and business. Now, tonight, he will apply his expertise to considering the most important issue of restoring trust in the banking system. This is, of course, very topical, and we're looking forward to hearing his lecture. We will be holding a short Q&A session after the lecture, and you will have the opportunity then to ask any question you may have. So, ladies and gentlemen, will now please join me to welcome Lord Griffiths to give the 2017 Mais Lecture.
Mr. President, Professor Volpi, ladies and gentlemen, it's a great honor to be invited to give the Mais Lecture this year, and particularly, as I think has been made clear, a personal pleasure. I was appointed to the chair in banking and international finance here in 1976, and felt that it was appropriate that, as a tribute to the previous Lord Mayor, Lord Mace, that we establish something in his honour, and hence the Mais Lecture. The first lecture, I remember, which I chaired, was given in 1978 by Sir Gordon Richardson, then Governor of the Bank of England, and he told me it was the first time that a Governor of the Bank of England had set out in detail the design and implementation of monetary policy. The text of the lecture was published in full the following day in the Times newspapers. And then since that time, as you've heard, various politicians and academic economists and central bankers have given it. The subject I've chosen for this lecture this evening is restoring trust in the banking system. And by the banking system, I mean the central bank, bank regulators, and commercial banks. And at the outset, I should make it very clear that this lecture is my own personal view and not that of Goldman Sachs, though I acknowledge a great debt to my colleagues at the firm for their continuing and valuable insights. Since the financial crisis, which began in 2007, the reputation of the city and trust in the banking system have never been more challenged. The UK Parliamentary Commission on Banking Standards described the crisis as a collapse of trust on an industrial scale. A review of what went wrong in one major UK commercial bank concluded that trust in commercial banks had been decimated because of the crisis. Since the crisis, each of the countries involved has undertaken a sweeping review of its regulatory structures, resulting in the creation of new institutions, like in the UK, the PRA and the FCA, new regulations covering capital, liquidity, compensation, resolution planning, governance and conduct, and more comprehensive and intense supervision, again in this country, the senior managers regime. Internationally, through the G20, the Financial Stability Board has sought to harmonize regulation. Yet 10 years after this immense effort, trust remains low. Only 20% of the UK population think that banks are well managed, which is down from 80% in the 1980s. The independence of central banks has been challenged over recent years in the US, the Eurozone, Japan, and the UK. And the view of the new regulatory structures by academics and commentators is, I think, could do better. If a modern advanced economy is to function effectively, it needs a sophisticated financial system which is trusted by the public. They must believe that it benefits society as a whole and not just bankers. They must believe that the services sold by banks are appropriate to their needs and priced competitively. They must have faith in the competence and integrity of bank leadership and respect for banks' corporate cultures. The financial system must be seen as making a contribution to society, not being an island within it. And it's against this background I wish to explore three challenges which I believe must be met if trust is to be restored in the banking system. The first challenge we face is preserving the independence of central banks from political control. This independence has been won only recently. With the Bank of England, it was 1997. Bank of Japan, same year. Sweden and the ECB 2 years later. It was a response to the great inflation of the 1970s and the accompanying stagflation of low growth and rising unemployment. Central bank independence cannot be taken for granted. We forget the 1970s too easily. I remember well, I was teaching at the LOC, in 1974, inflation in the UK averaged a staggering 27%. For short-term political reasons, at a time when interest rates were really determined by the Chancellor of the Exchequer and the Treasury, control of the money supply was neglected and replaced by control of the price of credit, the interest rate, and direct controls on the allocation of credit to certain sectors of the economy. The reason the independence of central banks, I believe, is important is that they alone, among all the economic institutions of a modern democratic society, have the ability to provide stable prices or low stable inflation. Price stability is important because it's a foundation for an efficient, functioning market economy and a prerequisite for confidence, growth, and prosperity. Stable prices enable participants to have confidence in the value of the money they use for exchange, its future value as an asset, and its dependability as a unit of account. Stable prices, in turn, depend on banks setting appropriate short-term interest rates to control the money stock. Any politician making such a decision will at some point in a democracy succumb to short-term political pressures. That's the day-to-day reality of modern politics. But this would inevitably mean a loss of focus by politicians on maintaining medium-term price stability. Independent central banks are therefore uniquely the guardians of stable prices in a democracy. Deflation can be as serious as inflation. And after the financial crisis, it was the independence, along with transparency and accountability, of central banks which enabled them to confront the threat of falling prices and enable the global economy to return to a path of recovery after a horrendous crisis. Despite this, the value of central bank independence is being questioned. The Bank of England is facing political criticism for its continued policy of quantitative easing. After 9 years, it's judged as counterproductive in stimulating investment and a cause of growing inequality by helping those on the property ladder at the expense of those who cannot afford to buy their own home. In Germany, a group of economists and entrepreneurs has challenged the legitimacy of the purchase of sovereign and corporate bonds by the Bundesbank on behalf of the European Central Bank on the ground that it crosses the line between monetary and fiscal policy and unduly burdens the ECB with troubled government debt. In the US, the vice chairman of the Financial Services Committee of the House of Representatives has stated that it was unacceptable for the Fed to continue negotiating financial stability rules, here I quote, among global bureaucrats in foreign lands without transparency, accountability, or the authority to do so. And that was pre-Trump. These could be perhaps dismissed as the views of politicians and commentators. I think more difficult to dismiss are the considered judgments of former central bank governors who are respected academic economists, thinking particularly of Ottmar Issing, who is really the architect of the euro, and Mervyn King, very distinguished academic economist and governor of the Bank of England. And in particular, the view of the Central Bankers Bank, the Bank for International Settlements. In its 2016 annual report, the BIS stated the following: "The extraordinary burden placed on central banking since the crisis is generating strains. During the Great Moderation, markets and the public at large came to see central bank as all-powerful. Post-crisis, they have come to expect the central banks to manage the economy, restore full employment, ensure strong growth, preserve price stability, and foolproof the financial system. But in fact, this is a tall order on which the central bank alone cannot deliver. The extraordinary measures taken to stimulate the global economy have sometimes tested the boundaries of the institution. As a consequence, risks to its reputation, perceived legitimacy, and independence have been rising." I think the BIS is absolutely correct, but I have to say I think facing up to these risks poses very difficult as well as very controversial challenges. I believe the most fruitful starting point is to recognize that the world in which we live is best characterized by Frank Knight's concept of true uncertainty, or Mervyn King's expression, radical uncertainty, rather than a world of risk in which the outcomes of alternative decisions can be measured in a probabilistic sense. I have to be careful as I realize that Paolo here is a professor of finance. In a world of radical uncertainty, we simply do not know what the future will hold. We do not know with any precision the connections between banks and financial markets. Similarly, we have limited knowledge of the connections between the financial sector and the real sector of the economy. And as we all know from the debate we've had in the UK since Brexit, forecasting is an inherently complex business with great limitations. It's important to emphasize that it's because of the success of central banks that parliaments around the world have given them increasing mandates. In the UK, the Bank of England's responsibilities now cover price stability, financial stability, prudential regulation, fair and effective markets, as well as concern for cybersecurity in the financial sector, fintech, and Brexit as they affect the financial system. However, I believe that these mandates which central banks have been given bring with them risk. One risk derives from the central bank's responsibilities for delivering financial stability. To start with, there's a serious debate, which we can't go into in detail tonight, about exactly what financial stability means as opposed to price stability. Presumably, it includes preventing future asset price bubbles and financial crises. However, a failure to prevent a future crisis, and as sure as night followed days there will be future financial crises, will be perceived as a failure in judgment and execution by the central bank, which could easily undermine confidence in its ability to achieve its monetary policy objective. Another risk is that the central bank will be perceived as designing policies impacting the distribution of income and wealth, which should probably be the preserve of elected politicians. Simply because of the need to set interest rates, central banks will have an impact on the distribution of income. Over the cycle, rates will rise at times, fall at other times. However, a general consensus has been established that such a result is acceptable in order to achieve price stability. However, targeting financial stability with direct controls, such as loan-to-income ratios for residential mortgages, and indirect controls, such as setting the minimum capital requirement to make loans to certain sectors of the economy, will lead inevitably to winners and losers, so making central banks open to the criticism that the implementation of these policies should be properly taken by politicians rather than unelected officials. A further risk arises from the fact that sometimes monetary policy has been used as a cover for what is in reality fiscal policy. I think one example of this was the proposal by the European Central Bank to engage in outright monetary transactions to do whatever it takes by purchasing the government bonds of countries that have not pursued prudent fiscal policies in order to keep down the cost of their borrowing. Such a policy is effectively a transfer from countries that have run their public finances well, such as Germany, to those that have not. And for some, this was a clear violation of the no bailout clause of the European Treaty. And the independence of the ECB has been further questioned by its participation in the design of bailout programs along with the IMF and the European Commission. In the light of these risks to the reputation, legitimacy, and independence facing central banks, the question arises, have central banks been overburdened by the increased mandates they now have, and has it created exaggerated expectations of what they can deliver? This is a serious and difficult question because while central banks must be independent of political control, they cannot be totally isolated from the political environment of which they are part. I believe for this to be addressed, there needs to be greater realism and public acknowledgement about what central banks can and cannot achieve. In this regard, I'm always inspired by reading Otmar Issing's work in his papers on this subject, by the emphasis he places on the need for humility on the part of central banks, simply because to reduce the behavior of a modern economy with a complex financial system operating in a global environment to a set of equations is exceedingly difficult, if not impossible. In addition, it's important that there is clarity regarding the responsibilities of central banks by comparison with the responsibilities of other economic policymakers. When the Financial Policy Committee of the Bank of England was first set up, the statement made by the then Chancellor, George Osborne, was that the bank, quote, will have the tools and the responsibilities to look across the economy at the macro issues that may threaten economic and financial stability and take effective action in response. This is a very broad remit indeed, which in my judgment blurs the line between monetary policy, fiscal policy, and structural policies, and ultimately poses a risk to central bank independence. As a result, I believe there's a strong case for requiring the central bank to give priority to what only it can do, namely setting a medium-term numerical target for inflation. This will come to be seen as the expected rate of inflation and have credibility because of the central bank's ability to control growth of the money stock. In the short term, in a world of radical uncertainty, there will be deviations in prices and output from their medium-term path. Because of this, the central bank, I think, should have discretion over the period of adjustment in returning to the medium-term target. And of course, in all of this, they should be transparent in what they do. Let me now turn to the second of the challenges facing us, and that is restoring trust by ensuring that regulation can be effective in a world of radical uncertainty. The years since the financial crisis have seen an immense increase in the extent, detail, complexity, cost, and supervision of bank regulation. In the UK, the US, the EU, Japan, and other G20 countries, the pendulum of regulation has been allowed to swing as far as necessary so as to give the public a firm assurance that taxpayers will not have to pick up the bill for future bank failures. After the last crisis, regulators around the world effectively sat down with a clean sheet of paper and set about a root and branch reform of the system. A number of academic economists and commentators advocated the most radical regulatory change, namely ending the fractional reserve system of banking and requiring banks to hold 100% of their assets in liquid form. And subsequently, this was supported by some of the leading names in the economic profession, including Frank Knight, Irving Fisher, Milton Friedman, and James Tobin. Their argument was, because money is a public good, which is vital for the efficiency and stability of a market economy, it's important to separate the creation of money from the creation of private sector credit. Narrow banks would have their deposits matched by 100% liquid assets, which would then consist of deposits at the central bank and the holding of government securities. Providing the public have confidence in governments to fund their future expenditures, there would never in future be a reason to have a run on banks if you have a 100% reserve system. As Irving Fisher put it, nationalize money, but do not nationalize banking. However, following the 2007-2008 crisis, this approach was considered a bridge too far. First, there was the disruption which such a huge change would entail, as banks reorganize their activities into narrow banks, backed only by approved liquid assets, and wide banks, which could perform other activities such as corporate lending. In addition, a rigid separation might well hinder beneficial innovation, including more flexible forms of borrowing and lending. And such a change would also transfer risks to non-bank financial intermediaries, with the prospect that the cost of capital of investing in real assets such as plant, machinery and house prices would rise. At the same time, governments recognize that in extremis, they have an ultimate responsibility to provide catastrophic insurance to support the financial system. Although a 100% reserve banking system would prevent a run on banks, if there were a shock to the economy, resulting in a sharp and significant reduction in total spending, central banks and governments might still have to step in and rescue wide banks rather than let households and firms bear the cost of significant falls in asset prices, including those of houses. One result of the pragmatic and piecemeal approach, therefore, which governments and central banks have taken, is that the banking system is far more robust today than it was in 2008. Retail deposits are ring-fenced from the complex risks undertaken by investment banks, and therefore the payment system is more stable. Banks are better capitalized, have limited leverage, hold far more liquid assets than before. Investors are better informed about the potential risks of investing in banks. New compensation structures for bank executives reward longer-term performance and discourage short-term risk-taking, with increasing use of deferred stock awards and clawback provisions instead of cash bonuses. Resolution planning allows banks in financial difficulties to sort out their problems without disrupting their basic services to clients. In other words, banks can fail, but without systemic repercussions. Finally, the senior managers regime in the UK holds specific senior individuals personally and directly accountable for their actions, and I'm one of them, with reckless management of the bank as a criminal offence subject to a maximum of 7 years in prison and a fine. These, I believe, are significant achievements by the reform of regulation, and they deserve to be recognised. However, despite these achievements, the new regulatory structure has come in for significant criticism. One is the charge of complexity. International prudential agreements started with the Basel Accord of 1988, which was a 30-page document. Basel II in 2004 was 347 pages, and by 2010, Basel III was 616 pages. In the United States, the Glass-Steagall Act of 1933 ran to 37 pages, Dodd-Frank of 2010 to 2,300 pages. Bank capital requirements account for much of this paperwork. I could go into detail here, but I shan't because time is limited. But the different types of capital banks have to hold is a very complicated business. The measure of what constitute risk-weighted assets is subjective, it's complex, and it can change very quickly in a crisis. Banks are additionally subject to stress testing, which again is highly subjective. Equally complex calculations and reporting requirements apply to banks' holdings of liquid assets, the structure of compensation, and resolution and recovery planning. I think nobody would ever dispute the complexity of the present system of bank regulation. A second criticism of the current structure is the increased deadweight cost to society of the new regulation. In advanced countries, regulatory bodies employ significant numbers of employees and consultants. In 1980, there was one regulator for every 11,000 people employed in the UK financial sector. By 2011, there was one regulator for every 300. At my own bank, we have one compliance officer for every 30 bank employees, which is not unusual for major banks. When added together, the number of people engaged in regulation runs to several 100,000. A further criticism, and which is a very interesting one, is that present regulation undermines trust and moral responsibility. Because under the present system, the primary duty for risk managers is making sure that certain numerical targets are met. Does this undermine a sense of personal responsibility and ownership? Instead of bankers being held accountable for determining appropriate amounts of capital and liquidity, which in reality are unique to the risks and nature of each business, detailed regulatory prescriptions can become a prop on which they can lean. John Kay has stated this precisely, I think very succinctly. Regulation based on detailed prescriptive rules has undermined rather than enhanced ethical standards by substituting compliance for values. A fourth, and perhaps the most important of all the criticism of the present system, is that it doesn't really address the challenges to bank regulation of an economy characterized by radical uncertainty. In a world of radical uncertainty, it's not possible for regulators to determine the appropriate amount of capital or liquid assets that individual banks should hold. What might seem the right amount at one time can easily change to be inappropriate in a relatively short period of time. As a result, banks should be made to think much more deeply about the way they deal with uncertainty in order to improve their management of risk. I believe the most comprehensive and innovative approach to dealing with this is that outlined by Mervyn King in his first-class book, The End of Alchemy, which consists of a maximum leverage ratio, a liquidity rule that effective liquid assets exceed effective liquid liabilities, that these rules should be implemented over a period of 10 or 20 years, that during the transition period, the existing prudential regulation, ring-fencing restrictions should be retained, and that the regulation, the scheme should apply to all financial intermediaries, banks and shadow banks, which issue unsecured debt with a maturity of less than 1 year. I believe that the benefits of this system are that it would drastically simplify regulation. Complexity would be replaced by two basic rules. It would dispose of detailed capital and liquidity rules and the challenge of defining risk-weighted assets. It would be introduced over a period of time, and it would avoid banks having to make a choice of being either a narrow bank or a wide bank, so enabling competition while at the same time limiting private wealth creation. To sum up on regulation, the architecture of bank regulation, which has been built up since the crisis, has resulted in a better capitalized, more liquid, more long-term focused, and more resolvable system. And this is no mean achievement. As a protection for taxpayers of a future financial crisis, it's a decided improvement. However, as I mentioned, there are the risks. And so I think we have to look at how we can retain what is good in the present system, but ultimately move it so that in the longer term we reduce some of the negative side of what we have today. And the third issue I'd like to turn to is the issue of restoring trust in banks themselves. I believe that in order for the public to have trust in banks, firstly, they must be convinced that the remorse expressed by banks regarding past failures is genuine, and that they really are sincere in wanting to reform. I believe one evidence of this is the commitment of all banks, the time commitment, the resources they've devoted to strengthening the processes of control. Most, if not all, bank management of systemically important institutions have undertaken comprehensive reviews of their business, followed by reforms which have then been fed back into training programs. The compliance and internal audit functions have conducted meticulous reviews of failures in their own institution and of the lessons which can be learnt from those in other institutions. However, banks are still being fined, and regrettably, I have to say, I think until the public sees results from bank reforms, such an extended period of time with few, if any, major regulatory problems, the public will remain skeptical. Next, in order to restore trust, the public must be convinced that what banks do is of value to society and not just to bankers and shareholders. The social value of retail banks is readily understood through ATM machines, debit and credit cards, checkbooks, online banking, and so on. The social value of investment banks is not nearly so well understood. Their clients are not the general public. Their financial products and services are complex. However, I believe investment banks are of value to society, and their real value to society is in raising funding for companies and governments and allocating capital to its most productive uses, either through lending directly or through the capital markets, through which risk is priced competitively. A third step in restoring banks is that if banks are to be trusted, they must themselves demonstrate that they are trustworthy institutions. Trustworthiness has a number of elements. One is competence. Basic to competence are the skills, knowledge, and experience of those working in banks to undertake the business. Along with competence, consistency in delivering a first-class service is important. Competence and consistency together mean that banks can be considered reliable in the services they provide and the transactions they execute for clients. And in providing these services, they will incur certain obligations to clients, which they and their clients must be clear about and, when necessary, fully documented. For banks to be trusted in this way, I believe that bank culture is important. We know that poor cultures have resulted in large fines. James Hesiod, Professor James Hesiod, who was a professor emeritus at Harvard Business School, spent more than 4 decades researching the relationship between business culture and business performance, both in the field and through case studies. On the basis of his research, he claims that an effective culture can explain as much as half of the difference in operating profit between companies in the same business sector. By an effective culture, he means one that unifies those who work in a bank in achieving their goals, their shared values, while promoting a supportive working environment, helping people develop. The reason the relationship is not simple is that the strength of a culture by itself is not enough. It needs to be accompanied by effective leadership, by openness to change, increasing quality improvement, and benchmarking against the world's best. But an effective culture can be a source of competitive advantage because of higher job satisfaction, higher retention rates of staff, a reduction in hiring costs due to employee referrals, employee ownership, increased productivity, and improved relationship with customers. Culture, however, is important for reasons other than performance. A good corporate culture is a good in itself. The culture of any business is an expression of the purpose of the organization. A business is a community of people who need to feel that what they do day after day serves a greater purpose. People come to work not just to earn money. They want to believe that what they do matters, that it is valued by society, and that the organization for which they work is a force for good in the world. People take pride in their work. They need to feel that the services they offer have a quality tag attached to them. They need to feel at home in the institution in which they work. They expect that throughout their career, the institution will help them develop as a person. Effective cultures create great places in which to work. They want the bank for which they work to be regarded as more than a profitable money machine. If an organization is to have a greater purpose, it is not enough simply to maximize profit within the law. Clients' interests must come first, relevant information must be disclosed, conflicts of interest must be managed, and the commercial activities of banks must be seen as contributing to society. Because of this, when discussing a piece of potential business, bankers must ask themselves key questions. Is this piece of business legal? Is it commercial? But also, is it the right thing to do? Put differently, not only can we do this piece of business, but in addition, should we do this piece of business? Business principles are the standard to which a bank aspires. A culture is what happens in practice. It's the way a bank does business day to day. What the financial crisis exposed was a glaring divide in some banks between high ideals and daily practice. In the euphoria of the boom years, the principles and values which bank leadership publicly espoused were not sufficiently robust to prevent bank management sailing far too close to the wind and ultimately out of control. In the build-up to the crisis, bad decisions and poor judgments resulted from bank cultures in which the pursuit of profit and personal reward became too dominant. Sadly, we've seen more examples in recent years. Building a culture, maintaining a culture, and changing a culture are far from easy. All take time and need to be attended each day in countless small decisions. There are no easy levers to pull, but the decisions management must take day in, day out, week in, week out, month in, month out, will in time serve to either strengthen a culture or to undermine it. One area I believe which is important is recruitment. Competence, credibility, commitment, the ability to work in a team, and the ambition to do well are important. But the ability to earn revenue must never be at the cost of the character of those hired. Criteria for promotion are similarly important. A person who is promoted because of the business he or she has built, but who lacks integrity, will diminish a culture. By integrity, I mean being totally open and honest about business selection, the state of the books, valuation procedures, resolution of conflicts of interest, respect for compliance issues, commitment to developing people, and concern to ensure that the values enshrined by the company are lived out day by day. Along with recruitment and promotion, another important area is compensation. If compensation is primarily based on earned revenue, regardless of the way executives behave, this will be the strongest possible signal to employees of the real values of the company. Compensation must take into account less tangible qualities, such as reinforcing the culture of the firm and the development of people. In the case of wrongdoing, compensation must be impacted. At the same time, good conduct, judged by people being role models for the values of the organization, taking ownership of the development of those who report to them, should also be rewarded. And I think in all areas, training is very important. It's a key to ensuring that the values of the business are understood by everyone involved and the ways in which they're critical to its success. In creating, sustaining, and if necessary, challenging a culture, the role of leadership is, in my judgment and in my experience, and I've sat on about 12 to 14 boards of companies, crucial. Leadership has the responsibility to articulate the values of a bank. Leadership is about setting out a vision and inspiring the staff. It's about defining the purpose of the business, the standards which are expected, and setting the right example. Leaders are the trustees of the values of a company. Leaders must establish the values, communicate the values, take ownership of the values, and then, most crucially, live the values. Perhaps the most important element of the culture of any financial institution is the tone from the top. People in an organization will judge how serious leadership is about its culture, not by what leaders say, but the decisions they take. Who in the business do they reward? And for what? Who do they promote? Would they remove senior executives whom they know were damaging the business by behaving inappropriately? Most important of all, do they themselves practice what they preach? One of the founders of a US company, ServiceMaster, New York Stock Exchange quoted company that I served on for 15 years, had this saying, which was up on the wall of the boardroom, if you don't live it, you don't believe it. Leaders have a responsibility to ensure that the tone from the top reaches down to all levels of the organization, especially the middle area, which a former senior regulator here in London described as the permafrost within an organization. Leadership within a bank exists at all levels, so that it includes not just the CEO and senior management. This means that leaders at all levels throughout the organization must own the values, communicate the values, and most important of all, live out the values. Crucial, I think, to tone from the top is the role of the board. One of the key responsibilities of boards is their role as trustees of the culture of the organization. This involves supporting management in its efforts to build the right culture. It also involves, when necessary, challenging management. A bank's culture is not easy to assess, and many boards do not have a structured process for reviewing a firm's culture in the way they do for risk, audit, governance, nominations, and compensation. It is a current challenge many banks are grappling with. For banks, the issue is how to recruit, promote, and nurture first-class, competent leadership which recognize the importance of character and values as essential to implementing business principles. In this lecture, I've sought to argue that restoring trust in the banking system depends on maintaining the independence of central banks from political control, with the overriding priority to maintain a low and stable rate of inflation. The importance of regulation for the banking sector, but also ways it might be reformed to reduce complexity, cost, and managing just in order to meet numerical targets. And within banks, they need to set out the purpose of the institution, its business principles, the obligations which doing business entails, and the role of leadership in establishing and maintaining an effective culture. And I believe the key to this ultimately is the personal responsibility of each individual working in the bank, which is built ultimately on character and values. Let me conclude with a personal story. Some years ago, I gave a lecture at Claremont Colleges in California on the business of values, to which the response was given by Peter Drucker. He described my lecture as the case for business as ethics in action. He stressed that the values of a business are a commitment to action, not preachments, which are at best only good intentions. The most decisive, unambiguous, and visible actions, he suggested, were those regarding people. Regardless of what the CEO may say in his speech at the annual meeting, what he does in rewarding, placing, or punishing people are the values the whole organization sees and takes seriously. And he then concluded with a personal story. Here I quote him. And with this I finish. Many, many years ago, at the very beginning of my working life, I had the good fortune to work for a short year for a man of rare integrity and great wisdom. I had tremendous respect for him. And so I was quite shocked when he did not promote an older colleague, let's call him Tom, who had clearly done an outstanding job. I was so troubled that I took my courage in my hands and went and asked the boss why he had so pointedly passed over our department's top performer. He looked at me with a smile and said, I know you are too young to have a son, but I understand you have a younger brother. Yes, I did. Would you, he then asked, want to have this younger brother work for 2 or 3 years under Tom and try to become like Tom? You are right, he continued. Tom has the performance, but does he have the character? It is when an organization asks this question and takes it seriously that its values become action. Thank you.